All right, everybody. I wanted to do a video. I've been getting a lot of questions with people who are new to options, asking. I hear people saying, selling options. How you have to. They hear people talking about to sell options, you have to have a different clearing with your broker and have more leverage. And then they're kind of like, well, what do you mean? Don't you have to be able to sell the options to buy them? And stuff like that. And I kind of wanted to just do a quick video on the different strategies you can do with options. Basically, with options, there are strategies to play any type of market, whether the market is consolidating, uh, just literally not doing anything, going straight across flat, not making any moves up or down. You can still make money, and that might seem crazy, but there are definitely ways to do it. And I just wanted to do a video on that. So basically, with options, I guess I'll say this: they have something called delta and then time decay, which are going to be kind of the two main things I'm going to base these strategies around. So delta is each option contract. For instance, let's go to. All right, let's make this bigger. So let's just say you have Apple. All right, so each option contract. Why isn't that right? Charles. All right. So each option contract you can come to is going to have a delta. And I know you don't see it right here. That's just because I don't have it up. I can bring it up by simply bringing these up. So as you can see, you have delta right here. So basically what this means is, and I'm not going to go into strike prices. I have videos on how to pick a strike price and all that. If you want to see those videos, check my YouTube channel out, Stock Junkie. Make sure you subscribe, and I have more videos to come. But this is just going to be about the different strategies to clear some things up. So you have a delta right here. So if you play the 120 strike, this has a 43-cent delta, 0.43 delta. So that means that every time, if you buy this call, every time the stock goes up $1, your option price will go up 43 cents. Now, there's other things involved like time decay and theta and gamma, so it doesn't necessarily mean every time the stock goes up $1, your option is going to go up 43 cents. But with all other things aside, if it wasn't a such thing as time decay and theta and all the other things involved, it would go up 43 cents. So what happens is you could buy a call and you're long delta. So that means you're going to be long, just like you're long a stock. If you're long a stock, when it goes up, you make money. Well, you're going to be long delta. So when the stock goes up, you're going to be plus this. You're going to be long this. So you're going to gain this 43 cents. Now, if you buy a put, you're obviously you're going to have a delta over here. You're going to be, see, it says minus. You're going to be minus that. You're going to, every time the stock goes down, every time the stock goes up, it would be minus 57 cents, and every time it goes down $1, you will gain at 57 cents. Vice versa over here. Every time the stock goes up, you'll gain 43 cents. Every time it goes down, you'll subtract that 43 cents. So this gives you the opportunity. You can buy calls for direction, just for purely. So one strategy you can play is directional based, just like with stock. If you think the stock's going up, you can buy calls. Instead of buying shares of the stock, you can buy calls for the directional play up. If you think the stock's going down, you can buy puts for the directional play down. Same thing as buying stock, except you're just buying calls and puts. So that's one of the ways you can play options, just buying calls and puts for the purely directional move. You buy the 120 strike on Apple, and if it goes up, you make money. And ideally, you want it to get, well, I'm not going to get too much into that. I have another video about that. But so basically, that's one of the strategies. You can buy calls and puts for a directional move up or down, just as if you would buy shares of the stock. Pretty simple, right? Now, even though, say for instance, when you buy a put, you're short that stock, but you're still long that option. Now, it sounds kind of confusing. So with options, when you would buy a call, if you think the stock's going up, you buy a call. you're buying to open. That's what it's called, buy to open. It means you're buying that call to open a position. So you're buying that call to open that position, and then whenever you're ready to sell it for a profit, you would sell to close. You would then sell that call to close that position. So you buy the call to open the position, then you sell it to close the position. Same thing when you're playing puts for a directional move down. You would buy that put to open a position, even though like when you're shorting a stock, you short the stock and then you buy to cover back. Well, this is already, the option contract itself is already shorting that stock. So you're not shorting this option contract, you're shorting the stock by buying this option contract, because this option contract is already, remember, it has a negative 57 delta, so it's already made in a way to where when you buy it, you're short that stock. So you buy a put, buy to open, you buy in this put to open open a position, which makes you short on the stock. But you bought to open. You bought the put to open a position, which made you short on that stock. And then whenever you want to sell, you would sell to close, instead of just like when so with a stock you would short the share, short the stock, and then buy to cover. Well, this is different. This is already set up in a way, once again, to where when you buy it, you're short that stock. So you buy to open and you sell to close the position. Now you can also do what they call sell options, which is it's called writing options. You can short these option contracts. So for instance, when you have a stock like Apple and you want to play the 120, let's say you want to play the 119 calls. So if you played the 119 calls around here, it goes up to 119.93. You're in the money. Okay, you make money. Let's say that you wanted, now someone had to sell you. All right, so you bought these 119 calls, but someone had to sell you those calls. So whoever sold you those calls lost money. Now, you can also be the seller of those. Oh, what am I doing? You can also be the seller of that. So if you want, you can short this contract. You can be short this contract. You can sell this contract. In other words, you can sell to open. So you can be the person that sold you that contract. For instance, if you thought, I'm getting all confused. Sorry. All right, there we go. So when you buy a call, obviously you want it to go up. But if you're selling a call, just think of it like this. You want it to do exactly the opposite of what the person who's buying it wants it to do. So when you're buying it, you need the stock to go up and you need to get into the money. Now, with selling it, you want the stock to either go down or you want it to consolidate until it expires worthless. Now remember, all option contracts, they all have an expiration. These are January 13th, 2017. Now, most option contracts are going to expire worthless because the closer they get to expiration, time decay is going to cut away at them. So if you buy a 119 call, right here, and it does this for the remainder, it never makes that move, and it just consolidates like from here to here, and it just consolidates the whole time all the way until expiration, that contract is going to expire worthless because it never made that move it needed to get in order for you to make those profits. So a time like that, the person who sold that contract would be in the clear. So for instance, like, think of it like this. If you sell a call, you're going to either want the stock to go down or you're going to want it to consolidate. Now, the reason you can make money with it just consolidating, if you buy a call or a put, you're not going to make money if the stock consolidates. You either need it to go up if you bought a call or down if you bought a put. But when you sell, remember, I'm talking about selling to open. You're selling the call to open a position. So when you buy a call, you're long delta, right? Stock goes up $1, you get plus that delta. Like I said, you get plus that 43 cents. But if you sell this call, you are now going to be the opposite of that. So you're going to be, you have these 119 calls, you're going to be now short this contract. So now you're going to benefit. All of this is going to be exactly the opposite. Just think of it as you're the seller. If this person wants it to go up $1 to gain this 23, you were selling it to him, so you want it to go down. Basically, this guy, if the stock goes down $1, if the stock goes down $1, he loses 23 cents, right? Well, that's going to be good for you. He lost 23 cents, but remember, you're the one who sold it to him. So whoever sold it to him made that 23 cents. So you want it to go down, because once it goes down, you're going to gain from this, because you're going to be short this contract. So you're selling to open a contract. I'm sorry if I'm tangling over my words. It's sometimes it can be kind of complicated for people to understand, but just think of it in simple terms. You are the seller of that contract. You want it to do the opposite of what he wants it to do. It's good because you can not only make money if it goes down, but you can make money if it consolidates. Because if you buy a call, remember guys, if you buy a call and it never makes a move and it just consolidates for 5 days straight until the contract ends, the time decay is going to eventually dwindle that contract down to zero. So the buyer of that call is going to lose, but whoever sold it to him won. Because remember, the bid price, if they sell you a contract, like say right now, if you wanted to sell this call, sell to open. Remember, you're selling it to open a position. There's someone there to buy it for $1. If you sell it to them and then it just consolidates all the way into expiration, slowly but surely you sold it for $1.02, remember? And then once it gets closer to expiration, time decay starts wiping it down more and more to, let's say, to where it gets to 50 cents. Then you sold it for $1.02, and then you buy it back for 50 cents, and then you make the difference between 50 cents and $1, just like when you short a stock. You short a $10 stock, it goes down to $9, you buy it back, you make the $1 difference. Same thing. You can short these contracts. It's called writing options. So you can not only make money with a call, when you sell a call, you make money if the stock goes down, or if it consolidates can be good, because the time decay will then be in your favor. So basically, with selling options, it can be very lucrative, and it can be you have a really good probability, because a lot of option contracts, say like 80% or something, expire worthless. So if it doesn't make that move, you're going to benefit from that, because you can just sell the contract, and just as long as it doesn't make a move up, you're good. Even if it consolidates, you're good. Obviously, you want it to go down. That would be the best case scenario. But same thing with this. So you would be selling this call to open a position, and then just like whenever you short a stock, you're selling it to open. Then whenever it's time to close it, you're buying it to close the position. You're covering it. You're buying it to cover the position to close it off. Same thing with puts. Puts, you can sell this put to open a position. So when you sell this put to open a position, if you would have sold the put, let's say you sold a 118 put, you would have benefited right here because it made the move up. Remember, if someone buys a 118 put right here, they want it to go down. So if it goes up, who benefits from it? If you buy a 118 put right here, remember, every time you buy a contract, someone sold you that. So just look at it like that's the easiest way to look at it, guys. When you buy if you buy a put, you're buying it from somebody. So if you benefit off of it, the seller, they lost money on it. So if you bought a put right here and it went down and you made money, whoever sold it to you lost money. So if you buy a put right here and the stock goes up, you lose money. So whoever sold you that put made money. So you can sell a put right here, sell to open. Remember, you're selling it to open a position. You're shorting the contract. So you're going to short this contract. Now, when you if you were to buy a put, remember, you're negative delta, but if you sell it, you're going to be positive delta. So therefore everything is opposite. So therefore a move up, you will make money, or if it consolidates. So just look at it like that. Options give you a lot of different ways you can play options, and there's also spreads, and I'll get to that in a second. So one more time, guys. Basically, you can buy calls for when you're buying options. You're looking for a directional move. Remember that. If you buy a call, it's just like when you're buying a call, you need it to go up, point blank, period. Just like if you buy stock. When you buy a put, you need it to go down, just like if you were to short a stock. Then when you sell a call, you either want it to consolidate and not make a move up and let time. So basically, the two things that are on your side, you have time decay and delta. That's why I said at the beginning, time decay and delta, because when you sell a call, you either want it to go down so that delta will work in your favor, or you want it to consolidate so time decay will work in your favor. So you sell a call, you want it to do the opposite of what the buyer wants. The buyer wants it to go up, so you want it to go down, or you want it to consolidate to where the time decay will to work in your favor. Same with the put. Remember, buyer wants it to go down, seller wants it to mainly go up or consolidate. Now there's also something called spreads. Now, spreads, they have a bunch of different types of spreads you can do with options. I'm not going to get into all of them, but I'll just do like your basic like vertical spreads. So what you can do is this is a little more for people who are a little more conservative. You can do something like you can buy out of the money like a 118 call, and then you can sell like a 120 or a 120 call against it. So at the same time, you'll be buying a 118 call and selling a 120 call. And what that does is, so you buy the 180. Remember, you're buying a 180 for a debit. They're going to debit you, just like you use a debit card. When you swipe a debit card and you hit debit, if you go to the store and you buy a pack of cigarettes for $5, swipe the credit card, it's going to debit you $5. So when you buy this contract, it's going to debit you $181. Now when you sell at the same time, you not only buy that contract for $181, you sell this contract for 16 cents. So you're going to get credited 16 cents. So basically, in simple terms, you're reducing your cost basis for this. Basically, you're making the trade cheaper. You're buying something and then selling something against it to reduce your cost basis, which that in return makes what they call a spread. Now, this is going to cap your profits a little bit, but it's known to be so you have a lot higher spreads have a lot higher probability of success, and it's known as a very conservative like income strategy, just to make conservative income. You're not going to get those home runs, 1,000% winners like I showed you on some of those videos, but you're going to have a lot higher probability of success. You're going to be reducing your cost basis, making your trades a lot cheaper. There's a bunch of good benefits. It's a very good strategy. So basically, you can do put spreads. You can do the same thing with put spreads. You can buy a 118 put or a 122 put, and then you can sell a 118 put against it. At the same time, simultaneously, you're buying both of these. You're buying this one and selling this one against it at the same time. And basically what it does is create a spread. So we'll look at the Analyze tab. I don't know if I want to do that right now. Let's see, Apple. Alright, yeah, I wanted to do like a chart for y'all, but I'm going to have to do a whole nother video on those, because I don't even know, a lot of people might not even know how to read the charts, and I don't want to get into all that right now. But yeah, so I'll do that a whole nother video on, that'll be a good video to do. I'll do a whole nother video on how to read the graphs. And so anyways, basically with options, what's cool about options is you can not only benefit from a move up and a move down, but you can benefit from the market complete. They have people who trade consolidation. You get these times of consolidation. For instance, you got SPY. Let's see for a second. You have these times of consolidation, like right here, from here to here. You see how I was in that range? Well, for that week, you could have benefited from that. The market went sideways, and you can benefit with these different strategies with options with consolidation. Because remember, options always have time decay. So when something is consolidating sideways, time decay, if you buy an option like a call or a put, consolidation is your enemy, because if something's just sitting still, you can't make money. You need it to either, if you bought a call, you need it to go up, or if you bought a put, you need it to go down, right? If it's just consolidating, all that's going to happen is, day by day, time decay is slowly going to chip away, and your option's going to go to zero, or, go down in value. So therefore, when you sell options, remember, it's called writing options. You're selling. I'm talking about, most of the time when people talk about selling options, selling naked options, they're talking about, and when I say selling naked, I mean you're selling something that you don't already own stock against. So that's something else I want to talk about. So remember, when you sell options, when you buy options, consolidation is your enemy. So the seller of that is going to gain from that. If it's the buyer's enemy, then it's the seller. That's a seller's friend. So okay. When you hear someone say, this is another thing I wanted to get to. So you have, I know you have a lot of people that also use options to sort of like an insurance policy. So let's say you own some shares of Apple. Let's go to the daily chart. Alright, so you own shares of Apple. It's been on this real big run, and you own shares, but you think it's pretty overextended. I think I don't want to sell my position, because I think it has more to go. You think in the long run that you think in the long run that it can go up higher. So you don't want to sell all your stock that you own, but you think it could have a pullback, and you want to, while it's pulling back, you want to be able to make money. You were making money all through here, and it's working out good for you. Everybody wants to keep making money. Well, when it starts to drop, so you don't lose money, you can make money. What you could do is you can use options to what they call hedge your position. So what you would do is you could do something. It gets very complicated. There's so many different ways you can do it, but you could do something like buy puts. That way, when the stock goes down, you make money. Therefore, you don't have to sell your position, because remember, you're bullish on Apple. You think Apple's going up, but it's going to have a slight pullback down to this 115 area. So you could buy puts against that position to make money from that pullback. Now, same thing. If someone's short a position, you can. All right. So if you hear terms you hear a lot with option is buying covered calls. All right. So if someone says covered calls, that means they're buying calls on a position on shares that they already own. They have the shares to cover that contract if they decide to execute the contract and all that. They have the shares to cover it. If let's say they own 100 shares and they buy one contract, they bought a covered call. They have the shares to cover it already. Now, if you buy that contract without the shares, it's called buying naked. You're buying naked calls. Same thing with selling options. If you hear somebody saying they're selling naked options, they're selling options that they don't own shares of. They're selling them naked. If they sell covered calls or covered puts, they're selling something that they already have the shares to cover with. So typically, when you sell naked, if you're just selling, it can be very dangerous, because remember, guys, when you buy calls and puts, you have a defined risk. So if you buy a contract for $1, the most it can do is go to zero, right? The most it can do is dwindle down to zero, and all you can lose is what you paid for those contracts. So you have a defined risk. You already know what your risk is going to be. But but remember, when you buy a call or buy a put, your upside is unlimited. Who knows? The stock can go up forever. If it goes down, it can only go down so much to where your option contract goes to zero and you lose what you put in. But it can go up, unlimited amounts. So your profit potential when you buy a call or you buy a put is unlimited, because there's no end in how high your option contract can go. But the seller to that is the exact opposite. Remember, the seller wants the exact opposite of what you want. So the seller, they have capped. When you sell an option, you have capped profits, because remember, they're selling. If they sell, okay, let's bring up the option chain for this one. All right, so take it back one more time. Now you can buy this for $1. The lowest it can do is go to 0 cents, right? So you buy it for $1. If you buy however many contracts you buy, it doesn't matter. I'm not going to get into the math and all that. It's pretty simple, guys. You buy it, the lowest it can go is 0 cents. So all you can lose is what you put up. Whether you buy 1,000 of them, one of them, whether you put up $10,000, $20,000, or whether you buy one contract for $100 or whatever the cost may be, all it can do is go to zero and you lose what you put up. But the person who sold that, and you have unlimited profits, remember, it can go as high, it can go to $10, the contract can go to $11, whatever. But the seller to that, remember, is the exact opposite. So when you sell this contract, remember, you get credit, not debited, sorry, you get credit. You're going to sell this and you're going to get a credit of $1. So if you sell something for $1, you want to buy it back for a cheaper cost. So you want this to dwindle down. Remember, you're going to want the stock to go down when you buy a call. That way this price goes down, or you're going to want time indicator to eat away at it. But the lowest it can go is $1, remember? So therefore your profits are capped. You can only make, the most you can make is $1.02 off of this contract. That's the most you can make. But your risk is, that's why selling options, to sell naked options, you have to have a different clearing. And that's the question I was basically wanting to answer in this. People are getting confused about selling options and what that is. So when you sell this option, you have unlimited downside, because you're the seller. It can go up to $10, or there's no end in sight to where it can go or how high the stock can go. So you can, your downside, because you remember you sold it and you have to buy it back. You want to try to buy it back at a cheaper price, but if the stock goes against you and starts going up, it could go to $10, $11, $12. There's no end in sight. So it's exact opposite. So when you go to sell naked options, writing naked options, remember, selling to open, not selling to close. Everybody, it's not that hard. You don't have to have. So whenever you buy options, you don't have to have like a margin account or anything. But when you sell options, you have to have a margin account, and you have to have a certain percentage of margin and capital in your account to how much you're trying to sell, because when you're selling naked options, it can be very risky, because your downside can be, it's unlimited. And when you're buying options, your downside is a set amount, and therefore brokers will not, put as much, restrictions on people to be able to do that. So that was basically what I wanted to answer. Sorry if I kind of tangled over my words, guys. Some of this stuff it's almost like it's crazy, because when I first started, I thought it was very complicated, this stuff, but now it's like it's so simple. It's so simple, it's complicated. It's like it's so simple, it's almost hard sometimes it can get kind of complicated to explain, because it's really just common sense, guys. And trust me, I still had a hard time So if you're still having a hard time, don't get mad at yourself. It takes a second to kind of grasp, but once you get it, you'll understand. So it's the best thing I can say is just look at it from a common sense point. If you buy this, you want this price to go up. So the seller of it obviously wants the exact opposite. He wants it to go down. And if you buy a call and you want the stock price to go up, you want it to go up, then the seller, he wants it to go down. So same with puts, guys. It's the exact opposite. I hope this video helped. I think did another good video that I'll do a video on soon will be how to read option graphs, and it's a very cool thing. You can plot out your options on here and spreads, and it'll show you basically what it'll show you. There's so many cool things, and I should probably probability analysis. I mean, there's so many. Here's your risk profile, and basically what it does is you can plot an option on here, whether you want to plot a spread, whether you want to plot a call, and it'll show you a graph of what your max profit is and what your risk is, and it'll show what price you'll break even at and all that. And I'll do another video on that and go through some of these different settings. I mean, different tools we have on TD. That's what I use for my options trading to set up, look at all my options and stuff. That's what I use for my charting. So I hope y'all like this video. If y'all have any questions, please feel free. I'm trying to think if I missed anything, guys. I know this wasn't in that detail. Maybe I should do another video in greater detail, but I think I pretty much covered mainly what I wanted to say. So yeah, there you have it. Remember, guys, you can buy contracts and you can also be the seller of that. So just always think, if you're buying, what does the person who sold it to me want? They want the exact opposite that you want. So, all right, guys, y'all have a good day. Make sure you subscribe to the channel.